Many people ask me, Upstart is doing great now, but what will happen if there's another recession? Don't forget, their revenue dropped almost 90% Q2 last year. To forecast what will happen in the future, we must truly understand what happened in the past. I found this video where one of Upstart bank partners talking about the pandemic, the impact to the Upstart product, and their loans. Like most banks, they also stopped accepting loans from Upstart Q2 last year, not because anything to do with the loans, but because they were very scared. Looking at the number of cases rising, millions of people out of work in record time, nobody knows what's going to happen. It seems like a good idea at that time to pause and watch where things are going. Same thing happened to those Wall Street institutions. All of a sudden, they do not want any loans, even though they are making good profit from those loans. What about Upstart loan performance during this time? Before the pandemic, in terms of percentage of borrowers who didn't pay on time, Upstart loans are very similar to the industry average, about 6 to 7%. But don't forget, the average credit score for Upstart borrowers was 25 points lower than industry average, meaning by industry standard, this group is considered high risk. This is the power of the Upstart model, serving a group of people who appear riskier by traditional standard and maintaining very similar default rate or impairment rates. When the pandemic hit, that rate for both Upstart and others increased. The industry average increased 10 percentage points, from 6% to 16% in May 2020. Upstart increased also, but only 6 percentage points, from 5% to 11%. More importantly, even for this 6 percentage point increase, most was driven by borrowers' hardship program, which Upstart offered, meaning these people were allowed to delay their repayment. The actual default rate, the percentage of people who decided not to pay back in this period, increased only very little. That's why by end of 2020, 93% of those people who were allowed to delay their repayment resumed payment, compared to the industry average of 88%. It's very clear that Upstart model handled both the initial pandemic impact and the recovery much better than traditional models, even though their borrowers were considered higher risk. Why? There's another video from the same channel where the CTO of Upstart explained this. The traditional model assumes people's ability to pay goes from good to bad in a recession. The reality is, most borrowers who can pay back in good times still make payment when economic situations are bad. So to price credit risk, the difference between each individual is much more important than the change of economic situations. And for those who are actually impacted by economic changes, Upstart model can be very responsive. They know a lot about each individual, where they go to work, which industry they are from. Each week, new information about the economy will be added into the model, which includes who in which industry might be out of work because of the pandemic, and who might be receiving checks from the government soon. This way, their model always stays up to date, in good times or bad, has a very good understanding of each individual risk and ability to pay. None of this is possible in the traditional model. Right now, even though Upstart is growing like crazy, the market situation is actually not very friendly to them because people are spending less, saving more, and have less needs for personal loans. This has a very significant impact on the demand for their product. Also, right now, because everyone has free money from the government, the default rates for all loans are low. Doesn't matter how you are giving out those loans. If you are Upstart, you understand each borrower's risk. You give out loans with the risk priced in. The default rate is certainly low. If you are somebody else, you do not really understand the borrower's risk, but you are giving out loans to grow your business anyway. Your default rate is also okay because people have money to pay now. Just like Warren Buffett said, only when the tide goes out do you discover who has been swimming naked. If you are the top student in the class, You almost wish the final exam would be very, very difficult. Sure, your score will be lower too, but that's when people can really tell how much better you are comparing to others. I re-listened to all the conference calls and interviews of Upstart management. I don't think they want a recession, but they do believe their model has been and always will be performing better than others. In the true test of a recession, those platforms who do not price in the true credit risk will suffer, potentially go out of business. Upstart will come out of the recession much stronger than before. I agree. Okay, if you like the video, please share with your friends. The video is not investment advice. Thank you. Bye-bye.